Welcome to Holy Buckets. This is Economics. I'm your host, Craig Guine, and today with us we have Jason Strasser, CIO and co-founder of Caption Partners. Jason and I talk about stocks, options, Robinhood, bonds, among many other topics dealing with the market. So sit back and welcome to Holy Buckets. This is Economics. All right, welcome. My name is Craig Guine, and with us today we have Jason Strasser. Jason, I was able to listen to a podcast called Establish the Run, and Jason was on there doing an interview. And I reached out to Jason via Twitter, and he graciously accepted to join us today. So I appreciate it, Jason. Welcome, and why don't you tell us a little bit about yourself and your background?
Sure. Thanks for having me, Craig. So my brief background. So I grew up in New York City. My parents were journalists. We did a lot of traveling when I was younger. I spent middle school in Hong Kong, so I got to travel the world. It was really, really cool way to grow up, but definitely had parents that were math and financially completely illiterate. Came back to New York City for high school. Went to Duke, studied engineering. I was biomedical and electrical engineer, and so again, my major at Duke was nothing to do with finance or trading. I didn't really even know what a stock or option was till later in my college career. And I always tell young people, like, you don't have to have it figured out that early in life. Like, you really have some time to figure it out. A lot of people I talk to think they know what they want to do way too early in life, and you don't need to figure it out that early. I started my career at Morgan Stanley in 2007. I was trading options. I was the junior tech trader. So we had like a senior tech trader. I was a junior guy booking trades, getting coffee, getting yelled at, all that stuff. And, the market crashed in 2008, and Morgan Stanley, the firm I was at, almost went under. So it was a very fascinating time just to get introduced to the world in that kind of environment. I left Morgan Stanley and started my own hedge fund in 2012. I was not qualified to start a hedge fund on paper. No one wanted to give me money. There were a few, but it was we started a hedge fund as small as you could and built it up. And what I always have focused on my entire career is options. And I try to buy ones I think are too cheap, and I would try to sell them so they're too expensive. And I just try to do it over and over and over and over again and hope that it all works out. And so we built, the fund I run now has about $200 million, which for hedge funds is very, very, very small, but still it's a lot bigger than when we started. And most of our investors are like, larger groups, like basically professional investors. There's some rich people, but it's a lot of professional investors that invest in hedge funds. And that's my brief story.
Awesome. That's unbelievable where you start in 2007 with Morgan Stanley. What was your biggest takeaway from doing that, starting out there and then growing into a $200 million, managing $200 million worth of money?
I think for me, my biggest takeaway was that I wanted to work for myself. I think at the end of the day, there's a lot of people, a lot of these companies, when you start off in life, it's all about sort of money. Like people get a paycheck, I'm making up a number. They get $50,000 for their first job. Then they're looking for a job that pays 60, then a job that pays 70, and they're trying to move up the ladder that way. And it is important to move up the ladder that way. But for me, I thought the way I always looked at things was that whether I made X dollars or 2X, my quality of life wasn't twice as good if I made twice as much money. That's how I always thought about it. And I always thought, like, what really makes the quality of life is having a job that you really like. And for me, like, running my own company, I can control the kinds of people I'm surrounded with. And when you're at a big bank, there were a lot of great people there, but it was also a very political place to be. And that's no knock on my former employee. That's just the nature of that type of environment. And so for me, I think my biggest takeaway is I learned what it was like to work in a really big place, but I sort of realized the kind of environment I wanted to work in. I didn't want to have to wear a button-down shirt to work every day. And I didn't want to have to you know, make friends with the right people in order to move my way up. That's not what I was interested in. And so that was, I think for me, that was the big thing.
That's awesome. I think that's great words to live by, and I think to follow. I guess kind of follow up to that is, what's somebody or something that you're looking for in people? Say if all of a sudden, people are going for a job interview, what are things that you're looking for, things that stick out?
For me at Caption, it's honestly like there's really two kinds of hires you can make. You can hire someone young, typically young, that has no experience. And then the second type of hire is you're hiring someone that's in the industry and looking for a place to work. They're two way different hires. So if I'm hiring the second type, a lot of it comes down to just what can they bring to the table right now? What skills do they have? Obviously, everyone has a learning curve when they join a new place, but it's more about like what they can bring to the table now. It's not that interesting, it's not, obviously personality is a big thing, but those hires to me aren't as interesting as hiring someone young who has no background in anything or limited background. And for me, I've always gravitated to people that approach the world through the way I approach the world. And part of my background I left out was that in college, I played a lot of poker. And that was, online poker. The brief history was a guy named Chris Moneymaker won the World Series in 2003. And every amateur thought they could play on the internet, including myself. And I was a terrible amateur in the beginning, but I got better over time and I put in a lot of work. And I learned my sort of approach for trading from poker, because it's, in poker, you can only control so much in poker. You have a hand in front of you. You have to make the best decision. And the best player doesn't always win. There's chess where like the best player wins like almost every time basically. And then there's poker where you just can't control everything. And so I've always gravitated to people that came from that type of way of thinking at the world, where not very overconfident people, more like humble people, people that understand that improving is a process where you make mistakes and you try to get better from them. I think a lot of the hires I shy away from are the fancy hires with the very arrogant kids that come from fancy schools. We more target the blue collar. I like the hardworking, more blue collar people, and also the people with the gambling background. I think is really good.
You think with that gambling background, maybe it helps with trading as well, where you're not, maybe you do suffer a big loss from time to time or a loss, and you're not just going to react, and you can kind of play through that and play your cards right, and all of a sudden it ends up, or you can turn it around, it ends up winning or something like that.
Yeah, I mean, like the biggest thing I learned from poker was how to lose. I had some like very serious, as far as percentage of my net worth, swings, and, to the good, I learned how to win. I learned how to lose. And like, when I started my career at Morgan Stanley, there were a lot of other 22-year-olds rolling in with me. I wasn't the only one. There was a whole class of us. And I remember one day looking around being like, what do I have against all these people? A lot of these Harvard 4.0s, like how, where do I fit in here? And I kind of realized like where I had the advantage was I felt like I had some emotional maturity because I'd gone through some things that I felt like they hadn't. Like I had lost like 30% of my money in a day. I had doubled my net worth in a day. I'd gone through those kind of experiences. And, when you go through ups and downs, you become more level-headed, more machine-like in sort of handling them. And I think that's honestly like the sad thing about poker and finance is you can't really think about money. You just have to just do the right thing. You can't think about like, oh man, like I just drove like 3 Lamborghinis off a cliff today. Like you just can't think of it like that. Because if you start thinking of it like that, it's just, you have to just sort of make the best decision you can over and over and over again. And I think that's I don't know, that really helped me when I started.
Absolutely. And a way that you could set yourself apart. I think that's something that we talk about, at least in my classes. How can you set yourself apart from others that people are going to notice you or recognize you, and you're hopefully going to be able to better yourself for that.
I think that's like so important. And I always say this to people. If you look at the class that they in the Morgan Stanley class that I was in, it was myself, there was a woman they hired who was like a very good tennis player. She lost to Serena Williams in the first round of the Australian Open. They hired, in my class, there was a ping pong player who was like one of the best ping pong players in Singapore or something like that. And, you know, there are a couple ways of getting far in life. You know, one of them is just being super smart and having amazing grades. I didn't have amazing grades, and I always felt like there were always way smarter kids out there than me. I felt like, though, I did have poker at the time, which I had a really good record in poker, and I felt like I had accomplished something. And a lot of people, you know, I went to a lot of job interviews where they were like, "Oh, poker, you're a gambler, you're an idiot, like you're just so degenerate, I can't hire you." And that's fine. But there was a place that appreciated my skill set. And what I always tell people is it's just better to stand out, even if it's something you don't think. Like, you could be like whatever. You could be like the best beekeeper. You know, you could be like just something. Like, just have something you're passionate about and really good about. And it goes a long way, because if you're thinking about it from the perspective of a company, there's always a ton of smart people you can hire. Like, there's infinite smart people with decent to good grades that you can hire. So standing out is super important. And the only way you're going to stand out is if you dig into something you're good at and you really like. And I think that's super important, no matter what it's sports. It could be anything.
Yeah. And I heard you say that on the Establish the Run podcast, is just find something that you're good at, stand out, and that's going to go a long way in your life and through life. So I love that quote.
Yeah. And networking is the other thing. Like, just, it's so important to expand your network however you can. And again, like sports, poker, traveling, any way you can socialize and just network with people is super important. And I think that for me, one of the things that I took really seriously is when I started my career is I was out meeting people 3 or 4 nights a week. I was getting drinks with my friends. I was going to meet new people. I think that's super important. Like, that's one of those things that you just can't create overnight. And it's hard to, it's the best networking works when, people are interested in what you have to say about something, and when you're interested in what they have to say about something. And so I always think just, the main way I can network now professionally is that I know a lot about this one little thing, options market, right? So a lot of people are trying to learn about the options market different ways. Like, I want to be the person, if they have a question or they think about the options, they call me. And I just think that in general, networking is also just super underrated.
Absolutely. I think there's a book by Harvey McKay talks about just digging your well before it's dry, and to have those networks and to establish those networks, and that's going to help you in life.
For sure.
So let's talk about this. I'll start with just stocks. And, in class, we talk about supply and demand, and, what's going to make stocks go up and down. Is it just supply and demand? Are there other factors that go into that?
So on a short-term basis, it's all about supply and demand. There's no a stock can always go higher from where it is now. It can always go lower from where it is now. There's just nothing. It's literally just a bunch of people buying or a bunch of people selling can move a price anywhere. Of course, there are things that happen. So if you think about the stock market, you really want to break it down into 2 things. One is the secondary market, which means stock is exchanging hands between investors. So like, I buy, Craig sells. That's a transaction in the secondary market. When people are trading Tesla like crazy, most of that is, investor A trading with investor B. The other thing is called like primary issuance. And that's what an IPO is. Like, when a company comes to market and the company itself is selling stock to the public. Or in Tesla's case, if you follow Tesla, like recently, they actually sold stock to the public directly. Those are two very different things. And I think, if you also think about like mergers and acquisitions, company A buys company B, like there are real things in the stock market where businesses are, changing hands at real prices. But the vast majority of what's happening is all supply and demand driven. And there's never a reason a stock can't go higher from where it is or lower, like zero bound. But yeah, it's just all supply and demand.
And so if more people are demanding it, the price is going to go up. More people are selling it and kind of almost flooding the market, price is going to go down.
Yeah, I mean, the way it actually works, so when you go on E-Trade and buy a stock, it's very likely, I guess Robinhood these days, it's very likely when you buy the stock that a market maker is selling it to you. So there are different firms out there, if you ever, Citadel, Susquehanna, Hudson Trading, Jane Street, and they go on and on and on and on, that focus on what's called high frequency trading, or a version of that is market making. And what they're effectively doing is they're trying to buy and sell stock from people like me and Craig. They're trying to say, oh, I'll sell it a penny higher, I'll buy it a penny lower, I'll sell it a penny higher, I'll buy it a penny lower. But what happens to them is everyone buys, the market makers start pushing up their offering prices higher and higher and higher and higher. And that's the actual mechanics of what's happening. It's a lot of the transactions is you versus one of these market makers. And when they start getting, they don't want risk. They want to buy and sell and have nothing. They want to collect their penny and move on with life. But if people are selling and they have to buy, they're going to lower and lower their prices. So the odds of them buying go down and down and down and down. So that's how it actually works.
Okay. So that market makers kind of, I don't want to say control the market, but they can set a price a penny higher or lower to kind of
They're just reacting. Yeah. They're just
Okay.
reacting to the market. They're providing, and we take it for granted when you go online and buy or sell stock that just gets done right away. The reason it gets done right away is at typically a reasonable price is because there are people out there whose job is to provide markets to the market, and they're making money off of doing that because they're making that penny here and penny there, and it really adds up. But it's also a service to the random investor out there, because it's really nice to have someone out there ready, waiting for them to come in to trade with. If it was just investor trading with another investor without a market maker, the market would be much less liquid.
Awesome. Options.
Sure.
What is options trading? What are we talking about here?
So options are a tool, and all an option is a contract. It's a piece of paper, and it says, Craig has the right to buy 10 shares of Apple for $500 a share in the next year. That's all it says. It's the right to buy or sell something in the future. So it's just a piece of paper. And the analogy I like to give is, let's just say we did this, but instead of a stock, we did Craig's house. Okay, I'm just making something up here. So say Craig's house is worth $1 million. I made that up. All right, so Craig has $1 million house. Now, I don't know Minnesota. I don't know the housing market there. But let's just say we had a piece of paper and it says, Jason can buy Craig's house for $2 million anytime in the next 10 years. All right. We can all agree that paper's worth something, right? Because if that house goes to 3 million or 5 million, right, I can go buy it for 2, and I just made a nice profit. Really, that piece of paper is a contract, is an option to buy Craig's house. And the value of that is all about how volatile housing prices are going to be in your area. So if you're in Hong Kong, for example, volatile housing market, that piece of paper is worth a lot more. Whereas I live in Oklahoma City, it's a typically shockingly quiet real estate market, and that paper's worth less. And when you're doing an option on a stock, that's really what you're considering, is how volatile is it going to be in the future. Because the right to buy or sell something, sorry, someone tried to call me. The right to buy or sell something in the future, the price of that all depends on future volatility. If the market expects things to be very volatile, option prices go up. And if the market thinks things will be quiet, option prices go down. So for things like the US presidential election that's coming up in November, option prices are slightly more expensive that capture that event, because people expect the market to react one way or the other based on the presidential election. Of course, like, the thing about options is that they're a tool to transfer risk. So like the most practical application is, say you're an airline. Okay, the airlines have to buy jet fuel, right? So if you're an airline, Southwest did a very famous option trade way back in the day where they locked in a very favorable price for jet fuel in the future. They bought an option to buy jet fuel at a certain price, and then jet fuel went way up. And so for years and years and years and years, Southwest Airlines had an advantage because they had basically done a very large trade where they locked in a much lower price for fuel. And that's the real world thing. It's someone that says, hey, I need to buy or sell this in the future. I want to hedge. I'm a farmer. I want to hedge my corn risk. That's the main point of options, is transferring risk. A lot of it today, though, are people speculating. And so it's a lot of it is people on Robinhood gambling. It's gambling. Like most people are just gambling. And the thing I always say about options is that they're fun. If you're using them for a practical reason to hedge, great. Like they're a very, very effective tool for hedging risks. If you're using them to gamble or you think you're really good at buying or selling them, you're probably not. It's pretty hard because you have to think about it like you're trading against professionals. So unless you're doing a lot of, and it's not saying you can't beat them, but it's kind of like sports betting. Like to think you could go bet on NFL Sunday football games and win, somebody out there can. But you got to know that like, oh man, the running back slipped in the shower and now, okay. Or oh man, there's a storm coming and no one knows about it. Or, you have to find some sort of edge somewhere. Right. And I think in markets, it's hard. So what I always tell people is options are really fun. If you enjoy them, play around with very little amounts of money. Don't do anything crazy. Don't expect to win. But yeah, it's kind of the same way I am with DraftKings. I'm a loser on DraftKings, but you know what? For me, on NFL Sunday, it makes my experience better if I put some money in DraftKings and I buy some lineups. So for me, it's worth it. And I think that's the same way you have to look at options, to be honest.
Awesome. So what happens if all of a sudden that option expires and that $2 million option that you have on my house and my house is now only worth 1.5 million? Do you lose it completely?
It's worthless. It's rip it up. It's done. So like basically, yeah, that's the thing about options. At the end, the options are at expiry. So in 10 years, they're either in the money or they're out of the money. And so valuing them is at expiry is very, very simple. It's if it's zero or however much they're in the money by. And, we use a lot of pricing models to price options in advance of expiry. But on expiry, it's very simple how much they're worth. They're either zero or whatever they're in the. So if the house is $2.5 million, it's 500,000. The house is $1.5 million. Options worth zero. Pretty simple.
And there's calls and puts, correct? You can call an option. Okay, so calls is going up, puts is going.
Calls is the right to buy a stock in the future. So if you own a call, the example I gave on your house would have been a call option. Like I had the right to buy your house in the future. That's the call option. And a put is the opposite. So the right to sell your house in the future. So in this example, let's just say I bought a put option on your house, Craig, and I said I could sell your house for $1 million anytime in the next 10 years. Well, in a weird way, that could be worth something because the market could tank, right? And maybe your house goes to 500,000. And then I said, all right, cool. Well, listen, I sell the house for $1 million. I can buy it back for 500,000. That's what a put option would be. And so, yeah. And puts are, when I was at Morgan Stanley, we would deal with people that inherited lots of stock in a company and they wanted to hedge it. And the most common thing would be buying put options. Mark Cuban is famous. Mark Cuban started a company called broadcast.com in the tech bubble. No one's ever heard of it because it was never anything. But in the dot-com boom, Yahoo bought broadcast.com from Mark Cuban. Mark Cuban would not be on TV and Mark Cuban would not be owner of the Mavericks if Mark Cuban didn't hedge all of his Yahoo stock in the tech bubble. So when Yahoo was worth $1 gajillion and Mark Cuban had all his net worth in Yahoo stock effectively, he hedged it with put options effectively. And when Yahoo went to basically zero from where it was in the height of the tech bubble, Mark Cuban still had his put options, which protected him. He had the right to sell the stock a lot higher. And so that's a good example of a practical sort of, why options exist. It's because different people want to move risks around and they're a very good tool for that. But that's what put options and call options are.
So then who's the one who is setting up these options? Is it firms or companies that say, hey, we'll offer this option out there for you to buy?
So the way it works in the US is that there's option exchanges. So I think it's really important to explain this. So like when you buy a stock, Craig, on Robinhood or whatever, you actually don't pay for it until 2 days after you did the trade. And whoever sold it doesn't receive that money until 2 days later. And that's called settlement. And when you buy a stock on an exchange, you don't worry. Sorry, let's make a better example. When you sell a stock on an exchange, you never worry about getting paid, right? no one ever says, man, I sold my Apple stock at 500. I hope I actually get that money. Everyone just takes it for granted. And the reason that exists is because we've set up exchanges. And exchanges exist for that exact reason, is that you want to buy or sell your Apple without worrying about counterparty risk. You want to make sure you get paid. And the exchange guarantees all those payments. So even if whoever bought that Apple from you didn't actually pay, the exchange is going to make it right. And all the people that interact on an exchange pay little fees that go to the exchange in exchange for the exchange running. And I think that ecosystem is very important. Options are the same way. So there are option exchanges. The exchanges decide what options to put on there. But effectively, there are about over 2,000 companies with options that are listed on exchanges. And which can, that most of the sort of companies that are worth anything have option markets on them. And the exchange picks exactly what the expirations are and what the different strikes are. So the strikes are just the price that you buy or sell something in the future. So in our example, it was 2 million for the first example. And yeah, so that it's all set up by the exchange. And it's a nice way of trading without worrying about counterparty risk, which is, there are different types of trading out there. Some of them are not on exchanges. That's called over the counter. That's like me and Craig making a bet on the side. And that involves counterparty risks. And if you read back about what happened in 2008, there were a lot of trades that were not done on exchanges. They were done over the counter. And they involved Bank A owing Bank B lots of money. And it destabilized the system to some degree. So most of the trading that anyone ever is going to do here is always going to be on an exchange. But that doesn't mean there aren't trades that can be done off an exchange.
Okay. How about shorting a stock? Now you're betting it to essentially go down. Is there a big difference between that and a put option?
There is a big difference. You're in both cases you're rooting for it to go down, but you have to remember a put option. The big difference is there's a whole timing element to options, right? Because you have a certain amount of time. So, generally speaking, if you think a stock's going to go down, but you don't have an opinion on when, shorting it makes more sense. That's when you borrow the stock from someone and sell it. So you have to return, you borrowed it, you got to give it back to them at some point. The hope is that you could buy it back cheaper than where you just sold it. That's what shorting is all about. So you borrow it, sell it, and then you say, hey, listen, I owe you the stock. I'll get it to you later. And you hopefully buy those shares lower. That doesn't have a timing element to it. Options do. So if you have a very specific event coming up, like let's just say, for example, let me just come up with a ridiculous example. Okay, let's just say, for example, you thought if Donald Trump was the president, it would be very, very bad for Mexican stocks. Okay, that's not the case, but let's just say that's what you thought. You might buy a put option that expires in November after the election on a Mexican stock, and hoping that maybe people will say, oh, the market wins. The view is that, this is 4 years ago, build the wall. And if you actually look at what happened 4 years ago, 2016, Mexican stocks went down when Trump won. It's obvious he was kind of a much more hostile than, Hillary was. So that would be an example where you have a specific catalyst. Option might be the most appropriate trade. But let's just say you're looking at, Macy's, and you're like, all right, listen, it's a department store. These are all going away, right? I don't know when, but they're all going to go away at some point. Maybe shorting makes more sense there because you don't have to worry about timing it exactly. Your piece of paper is not going to just vanish and run out of time. So those are the two big differences between those.
Awesome. I know you've mentioned it a couple of times is Robinhood, and their big thing is, hey, zero transaction costs and things like that. Well, they're making money somehow, and they can't continue to grow at that point. Where are they making money, and how are they making their money?
Very good question. So Robinhood doesn't charge you to trade, but on a high level to a young person, if anyone ever is doing something that appears to be for free, you should always assume that they're not just doing it for fun. They're doing it to make money. And in this world, whether it's Robinhood or other things, and Robinhood's doing nothing wrong in my opinion, but in just a big picture, a lot of things that look free aren't actually free. And companies exist to try to make money. So you should just, without knowing one thing about Robinhood, you should know that they're not just doing it for fun. They're doing it to make money. Now, what Robinhood is doing is called selling order flow. So there are professional market makers out there that want to buy and sell and do the opposite of what Robinhood traders are doing. The idea is that the Robinhood traders probably in aggregate aren't that smart. No offense to people in Robinhood, but compare that to a professional hedge fund, where you might have people working there that have a very good idea of what might happen on earnings or something like that. But in aggregate, all the Robinhood trades added together doesn't scare a market maker. And they want to buy the right to take the other side of those trades. And every person like Robinhood actually has to disclose where they sell it. You can Google it. You can look it up in their public filings. I think it's actually on their website. You can see exactly who Robinhood is selling their orders to. And Robinhood's making millions and millions of dollars by selling their order flow. And it's not necessarily disadvantageous to the random person buying or selling stock. I personally prefer business models where they're more transparent, so I can see exactly how much I'm getting charged. But yeah, what's happening is you put an order to buy 10 shares of Apple. Those 10 shares are being sent to an exchange, but directed to the exact spot. So there are a lot of different exchanges for stocks. There's over 20. So someone is buying the right to direct that order to the exchange of their choosing and potentially taking the other side of that trade if they want. That's what's happening. And someone's paying for that right. So yeah, you put an order to Robinhood. There is a professional that is paying to take the other side of your trade, which is what I always tell people is like, okay, maybe you are the best day trader of all time, but just know that there's someone paying to take the other side of it. That's what they think about your ability.
So it says that we're all pretty poor traders on Robinhood. Let's be
in
honest.
aggregate, probably. But I think the thing to highlight this year is that the retail traders did extremely well this year. A lot of the retail traders in February and March were more aware of the coronavirus stuff than some of the professionals. And then when the dip happened, Barstool guy or whatever, all these people started buying stocks. So this year is very challenging for people that took the other side of retail traders. So I think it's important to say that retail traders this year did better than professionals by a long shot. But remains, tomorrow's the new day. So that's what I always say.
Good. What kind of, and you kind of touched on it a little bit, what type of impact do you think Robinhood investors and traders have had on the market? Do you think it's made an impact or not at all?
Oh, it is 100% made an impact. I think the thing that's interesting is in the option market, you can buy an option that doesn't cost very much, but the professional that sells the option to you is going to buy the stock to hedge themselves. So let's just say you want to bet on Apple going up and you want to buy a call option. All right, Craig, I'll sell you a call option, but I have to hedge myself. And I'm going to buy Apple stock to offset the risk that Apple goes up, because I'm going to lose money on the call option if Apple goes up, but I'll make money on the stock if Apple goes up. So a relatively small amount of money you spend on call options actually results in a decent amount of money that I have to spend on a hedge. You might spend $100 on an option, and I might spend $5,000 on the hedge. So I think the real impact from Robinhood is when a lot of them start buying options all together, it actually does cause stocks to go way up. And I think Tesla is always the good example of that. There's just a gigantic amount of people on Robinhood buying options in Tesla, and it's absolutely causing the stock. I mean, one of the influences of making the stock go up. I think we've also seen the activity is just insane. Like, we've never seen this much retail activity ever. So if you're comparing this market to other markets, it's insane, the pickup. I mean, people were so bored. They were at home with nothing to do, no sports gambling. Like, if you're a degenerate, there was nothing to do. And now you had the market. It was all that was left. It was the only casino open. And so it really went crazy. But again, remains to be seen how much impact in the future. I think you're seeing it sort of slow a little bit. And I think if you see if you see people starting to lose a lot of money in options and things like that, I think you will see the activity pull back quite a bit.
Yeah, I think, kind of talk about that with the coronavirus and things like that. And I'm going to kind of jump around here a little bit, but, I think you hit it on the head where all of a sudden market might start to pull back. People start to lose money. Maybe they're not risk adverse and they're just going to pull their money and say, hey, I'm done with this. I've made my money. People are maybe getting hired more now with unemployment going down. Maybe that has an impact. I don't know. It's going to be interesting to see how it all shakes out.
Very, very interesting. I mean, and that's what makes my job interesting is that, trying to analyze some of the stuff. It's not like you can go back and look to see the last pandemic. I mean, it was the Spanish flu in 1918. I mean, the markets were a little different back then. So yeah, I think in general, I think just looking for a job that is interesting is really important. And as you can see, like markets are pretty interesting.
And do you think part of it is too, with the rebound that we had from, March of 2020 when it kind of went down, I think it was like the 17th, 16th or whatever it was, maybe the following week as well. Now some people, they don't have the concerts to go to, the ball games, the basketball games. Now they have extra money. They're not traveling. Hey, let's try Robinhood. Let's try E-Trade, whatever it is. And hey, we're going to put our money in there. We're making money. People love it. Do you think that helped with that bounce back a little bit, or do you think there's other factors with that?
I think it was a factor. I'm not sure how big of a factor. It definitely was a factor. I mean, the major thing that happened was the Federal Reserve stepped in and effectively started buying bonds that companies were issuing. And what's the Federal Reserve has basically done is, is put interest rates very low, is artificially push down interest rates. And as someone looking at economics, that it's extremely important to know what the interest rates are, because if you're going to buy a stock, let's just make something up. Coca-Cola right now, I'm guessing, I'm not looking at it, but gives you a 3% dividend yield. Okay, the value of that is all about what, let's just say that's the only value. Coca-Cola doesn't grow very much. I think it grows with like population, basically. It's not a very fast growing company. So most of the value is just on the cash flow that you're getting through the dividend. AT&T, whatever, take your pick on a company like that. How much is that 3% dividend worth? Well, if interest rates are, what do you get in your checking account now? I get zero. I don't know what you get. You probably get zero too. Everyone, yeah, okay, everyone gets zero. If you got 5% in your checking account or your savings account or whatever, you're never going to buy Coca-Cola giving you 3%, right? You're going to say, hey, I need that to be 7%. I need it to be 8%. And what the Fed has basically done is push interest rates down on government bonds. That was the first thing they did. And in the Corona times, they promised to keep the interest rates low on the government bonds for a long period of time. And then they started buying corporate bonds and even bonds of like crappy companies. And so effectively by making bonds super expensive and making them very unattractive, it's very, very, very helpful for stock prices, because stocks start looking very, very tasty if you're getting 0% in your bank and the government says, hey, by the way, it's 0% now and it's going to be 0% in 2022 and it's going to be 0% in 2023. Then you start looking at stocks and you're like, well, man, that looks a lot better. If we close our eyes right now and we open them and it was 5% interest rates, this market's down 50% or more, because it's all about interest rates. That's the big thing for me. And also, yeah, I think you do have to look at what the government response was. I think handing out that $600 a week to people was huge. I think a lot of people were making more money in Corona than they were, before Corona hit, and more time to sit around and look at Robinhood. So yeah, a factor for sure.
Well, yeah, I think you hit a huge nail on the head there, that just incentives and incentives matter. And, what's your incentive to maybe go back to work if you have that extra $600 a week and you're making more money that way? You can sit at home, like you said, make more money on Robinhood, and, banks are at essentially 0% interest. You're not making any money there. You're almost losing money. We haven't gotten to negative rates. Hopefully we won't. But it's going to be interesting to see. And kind of, with the Fed buying these junk bonds and AA bonds, which are junk bonds essentially, kind of maybe lacks that, or increases moral hazard maybe a little bit, just dealing with, you don't have that risk and you can take more risk as a company if you fail. Hopefully the Fed's going to be there to help you out.
Yeah. Whatever you learn in economics about a free market, this is not like this market is not like that. This market is set up to go higher. Like first of all, our president seems to very much care where the market is. And it's not just him, even before him, starting in 2008, really what happened was in 2008, the Fed stepped in when we really needed a lot of help, and they did a lot of things, but they didn't let things go back to normal when things should have been back to normal. So, once we had this recovery from the Great Recession, the Fed didn't just put interest rates back to where they used to be and stop buying government bonds. It never really happened. And now what's happened is because we never, by letting things go back to normal, you give the Fed more ability to do things if times get bad. But when Corona hit, they had less tools available than they normally would have. Because normally what they would do is cut interest rates, whatever, maybe try buying government bonds. But they'd already done that. So they had to sort of try new things. And, if you look at Japan, they sort of have their own issue in Japan because it's an older population that's shrinking. We take for granted in the US, because of immigration largely, we have a population that's growing. And that is a huge benefit to our economy. But in Japan, they have an older population that's shrinking. And they've tried all sorts of things, including buying stocks. That's almost the next step from the Fed. Like if you had to ask me, like, all right, after junk bonds, what's next? It's just buying stocks. And they've already done that in Japan. So yeah, long story short, these markets are not like the economic textbook fair market type of thing. This is just, it's like right now, it's just everything is being done to push stocks higher. But there's a limit to this because, when you start getting higher stock prices only because interest rates are very low, if something happens, obviously inflation is one of the things people talk about. If we get real inflation, the government might have to raise interest rates. And that to me is what is the unfortunate, if this goes on for years and years and years, and one day we get inflation, it's going to be really, really ugly because all these tools the Fed is using now are going to be less effective.
Which leads me into my next question. From 2008 and you're working at Morgan Stanley, and now in 2020, what do you think? Maybe the biggest difference is between the two, and maybe it's just the Fed's reaction and how quickly they reacted and the tools that they use, or is there something else for just the biggest differences between the two recessions?
So yeah, a lot different. So 2008 was a financial system was under attack. Banks were, if they had $1 of cash or of equity, they would have $40 of assets on their books. They were there was a lot of leverage in the financial system. And 2008 was all about that exploding. You had Lehman Brothers and Bear Stearns and a few others basically go under. And you had a whole bunch more about to follow. And the government stepped up and did what they could to fix it. And we should be very grateful that the government stepped in, because if they didn't, it could have been very bad for everybody. And but yeah, that was a financial system collapse. What the COVID thing was not a financial system collapse. No one was worried about banks blowing up during coronavirus. This one was, but in other ways, Corona was much worse. So I think the thing about Corona is just the sudden nature of it. The rate of destruction in jobs and economic activity over like a 2-week period, there's nothing else like it. 2008, they made that look like baby stuff. But on the other hand, to me, 2008 was much worse from a sort of financial markets perspective, because the government acted very quickly here, and they had a whole bunch of things that they knew would help the stock market. And the stock market's up on the year right now. So 2008, the market finished down 30 whatever percent. So yeah, I just think in general, 2008 was much worse and much different.
How about any of your biggest takeaways from this, from COVID, or anything that you've learned that you can use moving forward?
I think the thing that if I could rewind the clock in March and talk to myself, I would have what really happened in COVID was you and I are on a Zoom call right now, right? Like it's very likely like you probably wouldn't be asking me to be on a Zoom call. You'd probably be doing something else. And I think the takeaway from COVID is that it sped up sort of technology adoption everywhere. That to me is the big thing. And like buying things online, you know, if you just look at like brick and mortar retail versus online retail, you know, online retail was slowly eating brick and mortar away and away and away. COVID hit, and now like pretty much the entire mall and like more than half the stores in this country are probably never going to reopen again. You know, so the way I look at it is it just accelerated technology adoption. I think, I forget, it was Microsoft or one of these companies said like by 5 years, you know, like wherever we thought we would be in 5 years with technology adoption, it basically happened overnight. And I think when we look back at COVID, other than the awful, like, you know, the death and the awful way it was handled in this country, I think we're going to look back and that's going to be the thing. We're going to be like, man, look, these tech companies got a massive kick in the help boost from this because it forced everyone to do things like we're doing right now. And like my parents, for example, who are not like, my parents are like not technology unsavvy, but they're just my parents. They're just normal parents. And they weren't, you know, you just see the things they're doing now. You know, my mom wanted to, you know, for the Jewish holidays, wanted to have like like she had a team Zoom call set up on her thing. She knew how to, like that just would never happen before. So yeah, I think that's what we'll be remember this by.
Absolutely. And, you know, you've talked about, you know, retail and how that's, you know, who knows, these stores probably will never open, maybe over 50%. Real estate, you know, I thought this was interesting where, you know, I think commercial real estate's going to really struggle. And maybe not in all places, but I think of here in Minnesota, Minneapolis, like what's the point of bringing in people to these huge commercial buildings when you can do this via Zoom or other things? Maybe you go to smaller real estate and things like that. Do you think it's going to have a big impact on commercial real estate in areas?
I think it's a really good question because I feel like most of coronavirus, we sort of have a handle on what's going on. And I think with commercial real estate, it's a slower moving thing. You know, it's not like everyone just broke their lease the minute Corona happened. You know, it's going to take a while to see how it actually plays out. My general feeling is that when people are sitting there saying, New York City's over, you know, San Fran is over, everyone's just going to live in, you know, a nicer place to live, you know, work from online, lower cost of living. I think it's a little bit overdone. I still think my view still is that the cities will be fine. I think the truth is young people, I don't live in a big city, but I think young people want to live. A lot of young people want to live in those big cities and they want to have that experience. So I don't think we're headed towards a disaster there. I think there will be some distressed sellers and there'll be buyers waiting for those assets. And I think in general, just money is way too easy right now. And so I still think people, you know, look at real estate and maybe it's not a great market for it, but there's just a finite amount of real estate in this world. And it just seems like there's a ton of money out there looking for things like reasonable real estate deals. So I would be very, very surprised to see like a huge blow up in the commercial mortgage market or whatever. But that being said, it is one of those things that we don't have a good feeling of compared to other things. It's like we have a good idea of like how many people are signing up to Microsoft cloud services. Like we can see we have data points. We don't have nearly as much on that market.
Yeah, even just real estate. I don't know how the housing market is in Oklahoma City and whatnot, but you know, the housing market has really taken off here, especially lake homes and things like that, because people kind of want to work from home now and things like that. If they can do that.
Home improvement, housing price. Yeah. Same here. And I think, I mean, people will be spending more time at home, right? So it makes sense to me. But I do think if you close your eyes and open them in 5 years, my thinking is that you're not going to see like a world that was that much different than 2019 in terms of what cities look like. That's my view.
I'm going to throw one more at you. How about airlines?
Sure.
And, you know, airlines, I mean, obviously they're struggling here a little bit and people are starting to travel a little bit more, but I think of like elderly people maybe traveling less, or even businesses. Are you going to send people out to go see clients, or is it going to be more so Zoom? even though I think, meeting face to face is huge, I think that makes a big difference, especially like you were saying earlier with networking and stuff like that.
It's a really good question. I mean, I think it was, travel's down, I think 70% right now, or 80% at least. I still think that, I think you have to break out business travel from the leisure travel. I fully expect if we close our eyes and open them in 5 years to see leisure travel back to where we think it should be. I still think it's the thing most people, I mean, for me personally, like it's the thing I miss the most about Corona. I also think airplanes are relatively safe compared to a lot of things. You have air circulation that's like fairly safe, and you don't read a lot about people getting sick on airplanes. And, I just think in general, it's going to be hard for the airlines now. It's just this massive destruction of jobs and money, and it's just really, really sad. But I do feel like I'm not sure about the stocks themselves, because I think the airline stocks, there's going to have to be they're going to be losing money for a while and have to raise money in different ways, and that could be bad for the number of shares outstanding for a stock or the capital structure and things like that. But I do think if you close your eyes and open them in 5 years, I would be shocked if there was like a huge difference from 2019. I still think people are going to travel for business. I'm on the side that I think things will get much closer back to 2019 than other people I've been reading about saying.
Awesome. Well, that's a good outlook. I'm going to trust you and your outlook rather than other
That's
ones I've read.
I'm just guessing, man. I'm just guessing.
I think everybody is at this point. So
yeah.
I know we've talked Apple and Tesla a little bit, and I just wanted to pick your brain here a little bit where, Apple and Tesla both just split recently. And I think when Apple first said that they're going to split, it was about 380. It jumps to 510. And Tesla was at 1375, jumps to 2230. Are more companies going to split because of that when they see this reaction? How is it people being misinformed that they don't understand how splits work and people are throwing money at these stocks? I mean, I don't know. Can you explain it? Can it not be explained?
It's stupid. Nothing changes about anything when you split, just to be really clear. You can make the argument that maybe there's somewhere someone can afford a share of Apple that couldn't before, but those are like, in the scheme of things, those are not moving the needle. And like you said in the first question, it's just supply and demand. And if a bunch of people see a stock split and want to go crazy, that's fine. A company called NextEra Energy, NEE, they split and the stock went up like 5%. The next day it was down 5%. It doesn't just because like you see the Tesla and the Apples. I also think you have to look at the Tesla and the Apples in the backdrop of just money pouring into technology stocks right now. So there's just way more buyers and sellers in general of these companies. But yeah, like this whole like stock split thing is ridiculous. It makes no sense. Now, if you told me like XYZ company is probably going to stock split, yeah, sure. Like it seems like they're going up, so you should maybe just play the game. But I would caution people against thinking too much about this. And they're completely, it should just be nothing. So.
Yeah, and is there even a need anymore to split? Fractional shares are fairly new from my understanding. So is there even a need where, hey, I can afford a $2,200 share of Tesla, but I have $500 sitting around and I can buy, 0.23% of it or whatever.
Yeah, I do think that there's some psychological elements to some investors maybe thinking like a $4,000 stock versus a $50 stock. Maybe they think about them differently. So maybe there's some psychological benefit to not having like a stock in the thousands, but yeah, I mean, and it seems like they're coming for Amazon. Like, I mean, it seems like very like, I know Bezos has always said he doesn't want to do that, but it just seems like, I mean, if you're running those companies, like, why not? Like, maybe our stock will go way up. Like, what's the downside? So, I mean, if I was at one of those companies, I'd be like, sure, let's keep splitting, whatever. So
yeah, exactly. If more people are going to buy it, stocks are going to go up. Let's do it.
Whatever. Yeah.
Yep. Taxes. And I think, with people's buying, selling, and maybe more people trying to day trade and things like that. Do you mind just going into that where, if you hold it for over a year, you're going to get taxed differently than if you're trying to buy, sell, trade, and do all that in under a year?
Sure. So there's a really good book. It's not about taxes, but it's about maybe the investor that understands taxes better than anyone. It's called The Cable Cowboy. It's written about John Malone. John Malone is a media executive who is. The book is like underrated, and it's actually like not even that easy to find. I think it's on Amazon, but it's a little, I don't know. It wasn't that easy for me to find it. It's the story of John Malone and how he started his business. And he says something that always stuck with me, which is basically whether you're in business, the way you need to think about your life is that everything you do, you have the government as your business partner. So his way of looking at the world was, I want to start a company. Whenever you start a company, no matter what company it is, the government is your automatic business partner. You should think of them as like whatever, a 30% business partner. However, with taxes, there are things you can do with your business partner. So for example, John Malone, his whole thing was delaying paying his partner, delaying taxes as much as you can. And it's incredibly powerful to delay taxes as much as you can compared to paying taxes right away. So John Malone, if he bought a stock and it went way up, he wouldn't even, the way taxes work, like you said, if you hold it for less than a year, there's a higher tax rate than if you hold it for more than a year. So if you ever have a big winner of a stock, it is almost always correct to hold it for a year. Like it's you should never be holding a stock for 9 months that's way up, like, and selling it. You should always be holding it and waiting for it to be long term. And that's something that's very important to pay attention to. But like someone like John Malone would never, like, and Warren Buffett's a good example. How many stocks has Warren Buffett sold? Like the only stocks he really sells are losers. So he had a bad investment in Kraft. He had a bad investment in Wells Fargo. He had a bad investment in his airlines. He sells those because when those are down, he gets a tax benefit from selling them. How many shares of American Express has he sold? How many shares of Coca-Cola has he sold? He doesn't sell any of those because he's got a massive tax bill waiting for him if he sells those things. So what does Warren Buffett do? Well, he borrows money against his portfolio, whatever. What John Malone does is the same thing. He has assets, whether they're stocks or they're businesses. They increase in value. He borrows more money against those increasing in value, and he buys more businesses. And that's a very effective tax because when you borrow money, the interest you pay is you can write off. And if you never sell a stock, you never have to pay your silent 30% partner, or at that point only 15% because it's long term, whatever your state is, plus your estate. And I just think in general, 401ks, IRAs, health savings accounts, those tools, smart investors always find ways of tax deferring. And you should do the same thing when you invest. I think one of the best things you can do with stocks is buy them and just hold them buy companies you can just forget about and hold for long periods of time because you don't pay taxes until you sell. And even one day, if you need cash, you can even borrow against that portfolio. It's a little risky to do that, but you can borrow against a portfolio and not pay any taxes. So there's just a lot of smart things people do. I think if you really are interested in taxes and want to hear about the best guy ever with taxes, you should read Cable Cowboys, which is not about taxes at all.
Perfect. That's next on the list. So I'm going to go to Amazon right here and buy it after this interview. So appreciate that.
Yeah.
Just a couple more here for you, and you've kind of touched on it, but just best advice for young investors or kids or young people who are getting into investing. I know you just said buy and hold and something that you can hold on to for hopefully a long time.
Yeah, don't try to day trade. Don't try to read charts and technical analysis. I think the one thing I see is that people assume that like right now you can like learn anything by yourself on the internet. You can learn how to build a car or whatever. You can do anything on YouTube and Google. You can learn anything. And people have this attitude like I can learn how to do anything on the internet, but you really can't learn how to day trade on the internet. I haven't seen the resources out there. It's like 99.9% at least total crap. So don't just don't. Like there are other things you can do with your time, in my opinion. However, as an investor, it's not like buying some companies that either you believe in or just buying an index fund and just not thinking at all about the companies and holding them for a long period of time. The stock market makes 8% a year historically. Now the stock market now is higher than, like, valuations higher than normal. So maybe you can expect 4 or 5% a year now going forward. I think a lot of pensions put out their estimates. It's like 5 something or whatever. But yeah, so, okay, that's not bad. And if you compound that when you're young and you're saving money and you're doing that, I think that's really, and avoiding paying taxes legally, I think that is a really smart thing to do for a young person who has money saved up or whatever. Don't, honestly, the option stuff, the short-term trading, the technical analysis, just don't do it. The resources online are not good. The way you learn trading is you get a job with professional traders that know how to trade, and you work with them. That's how you learn. If you want to make it your career, that's one thing. But for some reason, people think like trading is like the thing you could do like for part-time and be great at it. It's really not that easy. Just don't.
How about any advice for kids or students who want to maybe get into trading someday or as a career, or any suggestions for them?
Study hard sciences. Study. Don't. It's good to. I'm not trying to knock on you. I know you're studying right now for economics, but like, honestly, like, for trading specifically, I think like math, statistics, hard science stuff is a really good background. Doesn't mean also like having introduction. The one thing I wish I took more seriously or learned about in school was accounting. I didn't have any accounting. I had to hire a tutor later in my life to like catch me up on that. But for the most part, study something that you really enjoy. But if it's okay if it's not finance, it can be a hard science. And I think a lot of people prefer, especially this day, like, I think if I was a young person, like, not everyone wants to be a computer programmer or needs to be a computer programmer, but it's crazy not to have an education on how computers work and how programming works. Like, everyone should really understand that stuff really well. So yeah, I would give young advice is learn how computers work, learn how programming works. You don't need to be a programmer, but at least have some understanding of it. Study something that you really like, and stuff like hard sciences and math is really looked on favorably by the industry. And then it's all about networking. It helps if you go to a good school or if you have some sort of other way in to get a job. I mean, like, the bottom line is that the difference between, like, I went to a good school, Duke. The difference between Duke and University of Oklahoma, I do a lot of I've done a lot of talks in some of their classes there. Honestly, the kids are super smart. The kids are super bright. The big difference I noticed between Duke and University of Oklahoma is that when the kids graduate, there's a whole bunch of companies showing up at Duke trying to hire you, and at OU, it wasn't the same. And so that's really the thing, is like, going to a good school. I'm not convinced you get like a way better education, but I am convinced the networking is pretty good. So those are the things that could help you get a job in finance. Yeah.
Awesome. Appreciate that. That was, that's great. And it's great for our students to hear that, for sure. Any final advice or thoughts or closing things that you want to say?
Yeah, first of all, I'm on Twitter. If anyone has any questions, just shoot me a message. I'm happy to answer them. I think, like, honestly, so these are high school students, right? So I feel like it's way too early to like worry about serious stuff. Just enjoy yourself. Like, that's honest truth. Like, but like, I do think there are a lot of people that waste time on things that they aren't good at. Like, people that play a ton of video games. If you're really good at video games and you're passionate about it and you're really trying to improve and you're competing at a high level of video games, that's great. Like, that to me is an awesome thing. But I do think a lot of young people, whether it's video games or whatever, spend a lot of time on things that they're not that good at, that they're not, it's probably close to wasted time, if not wasted time. So just try to fill your day with things that you like, that you're good at, and it'll really help in the line.
Awesome. I appreciate that. And that's great advice for students to listen to, and seniors sitting in an economics classroom. So, Jason, I appreciate it. Thanks for your time.
Thanks, Craig. Anytime.
I can't thank you enough. And he's serious when he says reach out on Twitter. That's what I did. So I appreciate that more than what you know. So thank you very much.
All right. Thanks, Craig. Good night.
Yep. You too. Take care.
Bye.
Bye.
Bye-bye.